Straight line depreciation is a tried and tested method, which is used by some of the largest companies in the world, as well as your neighborhood grocery store. A short definition of depreciation is the decrease in value of a tangible asset over time. The main idea of depreciation: buy a tangible asset, like a machine, now, then use and expense it over time. When you buy the machine, you put it on the balance sheet as an asset, something you own, as you expect to benefit from it for more than 1 year. Then in each of the years of usage, you take a piece of the asset from the balance sheet into the income statement as depreciation expense. In straight line depreciation, the size of that piece, in other words the amount of depreciation expense, is the same every year. Let's have a look specifically at the straight line that is so important in straight line depreciation. The straight line runs from capitalized value on the left to residual value on the right. The capitalized value is the money spent by a business or organization to acquire or upgrade fixed assets, such as buildings, machines, and equipment. Residual value is also known as salvage value, scrap value, or trade-in value. Residual value is the estimated value of the fixed asset at the end of its useful life. The straight line in the graph represents net book value, which is the capitalized value minus the sum of the depreciation expense over the history of using the asset. In the straight line method, depreciation expense is the same amount every year. In this example, we go from capitalized value to residual value in 4 equal steps. The depreciation expense formula helps you calculate the depreciation expense. In the numerator, calculate the total amount to be depreciated, the capitalized value minus the residual value. In the denominator, input the estimated useful life. Let's discuss each of these terms. Capitalized value is any cost incurred to acquire, transport, and prepare the asset for its intended use. The capitalized value can include shipping and installation cost. Residual value is the estimated value of a fixed asset at the end of its useful life. Try to support your estimate by solid data, rather than it being a wild guess. The estimated useful life is the number of years that an item is estimated to function when installed new and assuming routine maintenance is practiced. How to calculate depreciation expense? Let's feed the numbers from the example into the depreciation expense formula. With a capitalized value of $100,000 and a residual value of $20,000, the amount to be depreciated is $80,000. If the estimated useful life is 4 years, then the annual depreciation expense is $20,000 per year. If you want to record depreciation expense on a monthly basis, then simply divide that number by 12. There are 2 ways to put the $20,000 depreciation expense per year into perspective. It is 20% of the original capitalized value of $100,000 or 25% of the depreciable amount of $80,000. Let's apply those numbers to the straight line depreciation graph. We start off with $100,000 fixed asset value when the asset is put into service, when it is ready for its intended use. During year 1, we depreciate $20,000 and get to a net book value of $80,000 by the end of year 1. This $80,000 is the starting point for year 2. During year 2, we depreciate another $20,000 and now get to a net book value of $60,000 by the end of year 2. Year 3, depreciate another $20,000, which brings us to a net book value of $40,000 by the end of year 3. And then in year 4, depreciate the last $20,000 to end up at the residual value of $20,000, by which point the asset is taken out of service and hopefully sold for an amount close to the expected $20,000. The journal entries for straight line depreciation are as follows. When buying the asset, debit fixed assets on the balance sheet for $100,000, credit cash on the balance sheet for $100,000. When recording the annual depreciation expense, debit depreciation expense in the income statement for $20,000 and credit accumulated depreciation on the balance sheet of $20,000. Accumulated depreciation is the title of the contra asset account on the balance sheet, which is used when depreciation expense is recorded each accounting period. The accumulated depreciation amount on the balance sheet keeps growing over the years, all the way to the point that the fixed asset is fully depreciated, or the point when you reach the residual value. Net book value equals gross book value minus accumulated depreciation. In our example, $80,000 at the end of year 1, $60,000 at the end of year 2, and so on. What kind of discussions happen in real corporate life on the topic of depreciation? First of all, capitalized value. The incentive from the profit maximization perspective is to capitalize as much as possible to spread the expense over multiple periods. Finance needs to be the voice of reason and objectivity in this evaluation and stick strictly to the accounting guidelines on capitalization. For residual value, there is upside or downside possible when market prices fluctuate. For example, when Tesla drastically cut the prices of new cars, this had a significant effect on prices in the second-hand market, which drive the expected residual value. For estimated useful life, finance people and engineers need to work together and evaluate what is the best point in time to replace certain fixed assets. This factor can be the most impactful. What you will often read in notes to the financial statements of an annual report is the current estimate of useful lives represents our best estimate based on current facts and circumstances. If an asset functions well, an extension of its useful life can benefit the company. Extending the useful lives of assets results in a reduction of depreciation expense, hence a positive impact on the P&L, the profit and loss statement. When you dive into the notes to the financial statements of large companies, you will find that estimated useful lives matter a lot. For example, in 2022, Amazon concluded that longer useful lives are possible due to continuous improvements in hardware, software, and data center designs. As a result, they extended the estimated useful lives of servers from 4 to 5 years and those of network equipment from 5 to 6 years. The financial impact was $3.6 billion. Decrease in cost, increase in pre-tax profit. Meta Platforms, the parent company of Facebook, reached a similar conclusion in 2 smaller steps. Estimated useful lives could be extended due to the expected longer refresh cycles in its data centers. The estimated useful lives of servers and network assets went from 4 to 4.5 to 5 years, an impact of $860 million. Alphabet Inc. followed suit in 2023, taking the estimated useful lives of servers from 4 to 6 years and those of network equipment from 5 to 6 years. $3.4 billion of depreciation expense upside. What is interesting here is that different companies adjusted their accounting policies around estimated useful lives in different accounting periods, and that after the changes, there isn't 100% alignment between the companies about how to depreciate very similar assets. So if you want to compare the financial performance of companies, beware of the small print and any one-off effects that impact the performance.